perspective, with the aim to contribute to the discussion and to the debate, making known the changes carried out and taking place, analyzing what they mean and how they influence the future politics in the monetary and financial union within the European Union. I sound a little bit optimistic if we consider that this presentation is bound to become an annual appointment with the euro for all those professional and institutions concerned about this development. You know that after the European elections, the European Union is in a crossroads and we have to face new challenge. And one of these challenges will be the monetary union and many others related measures that have been to be in place in the near future. And this is what the panelist is going to discuss. Last year has been especially delicate for the European Union. The Brexit is a process that is not resolved yet, and we hope it will be resolved in October when the new Commission has to be in place. The protectionist tensions in the trade policy from the United States and the disputes arising between the United States and China have to reivindicate from the European Union perspective the role of multilateralism. It seems that after the European election, populism and nationalism has been contained. If we look to the result of the European Parliament, 2/3 of the European Parliament are members that's from center-left, center-right, Green and Liberals that are pro-European Union integration with different perspectives and different measures. And I think in the panelists will be sharing this different perspective, but it will enrich the discussion, of course, for the future. Faced with this scenario, the only answer should become, in my opinion, for more Europe. More flexibility and more common actions, the role of the multilateralisms, and of course to promote reforms to enhance monetary union, fiscal policy and convergence, promoting a structural reform for a more inclusive, social inclusive growth, and of course sustainable financial and investment. I will end my intervention here. I am really glad to be with all of you today, and I will be following the different interventions, above all the discussion that I hope will be fruitful and very interesting for all of you. Thank you very much, and I think, Javier, you have now the floor.
Thank you, President. Okay, I don't know if it's all right with the mic, with the volume. Okay, just add just a few things on top of Mr. García de Quevedo's speech. Well, first of all, good afternoon to everybody. I'd like to join him. I'd like to join the President in thanking Bruegel, its director and team for once again organizing and hosting so warmly this presentation in this prestigious European institution. And of course, thanks to all of you joining us here, present, all of you present here and those following us online. I don't have to stress the fact that at the Fundación de Estudios Financieros, we're extremely proud of this publication and very thankful to Fernando Fernández as its director and to Fundación ICO as our partner in its funding and development. Our main idea is that we deem the Anuario as something quite unique, at least in Spain, where unfortunately there is a lack, to our belief, of continuous research on a yearly basis of the Euro's issues in a single-purpose publication. Actually, to put it in a very simple fashion, the yearbook is an annual revision of where do we stand, what has happened, where are we leading to. And this is extremely convenient for practitioners in economics, finance and law, academics and policymakers, and obviously for the public in general as well, as financial education to citizens stands at the forefront of our two institutions' objectives. And this is also extremely important, as there is no doubt that the euro is sliding swiftly into becoming a political tool, as well as being an economic and financial anchor for Europe's institutional architecture, which was obviously its original purpose. Not by chance, more pages, as you will see, more pages of the yearbook have been assigned to political issues in these past editions. But where do we come from? Way back in 2011, we reached the conclusion that we needed a real in-depth, intellectually sound and practical guide to follow the events happening in a Europe in turmoil. For this purpose, we asked two prestigious professionals named Luis de Guindos and Fernando Fernández to do the job. Finally, Fernando took the burden as Mr. Guindos left to take a top post at the Spanish government. And Fernando came up with the first of a series of publications that ended up becoming the Euro Yearbook, in a joint effort with Fundación ICO, to whom, let me stress it again, we are extremely thankful for their commitment and for their professional work. So, to finish off, let me get back to the questions I posed to you. First, where do we stand? It is obvious we stand at a crossroads, as the President has just mentioned, where politics and politicians will define what's next. Something I believe it was never in the minds of the single currency's founding fathers. Next question was, what has happened as of lately? The last news don't seem quite reassuring. Maybe the reason for this is that we haven't done our homework as we should have. And my guess is that this is going to be at the bulk of today's discussions. And finally, where are we leading to? And for sure, that is what Fernando is thinking right now for next year's edition. This will obviously depend on a mix of economic and political circumstances going forward that we can enumerate today, but that obviously as well we cannot predict in their full outcome. Maybe the only thing left is to put forward if we're positive or negative on this future outcome. But of course, this is the job for today's participants in the discussion. Thanks so much.
Thank you both for your words. Bruegel is also very glad to have you here. This has become quite a regular exercise. I will now give the floor to Fernando Fernández, Director of the Annual Review of the Euro, to present the main results from this year's study. Fernando, the floor is yours.
Thank you, Ines. It's a pleasure to be here. I think it's the fourth year in a row that we present this year report in Bruegel. And we're very glad for that, and it's been really a privilege to do it here. It's becoming customary, so probably some of the things that I say you may have heard before, because unfortunately, despite all this optimism on the table, I do not share this optimism. I think we missed another year. And if you have the time to read the report, you will see that there's some sort of a pessimistic undertone in it. In fact, it's been criticized because of that, probably because expectations are very high. Before I do that, let me start by again thanking in particular José Carlos and Javier, the Fundación ICO and Fundación de Estudios Financieros, for something that may seem very simple to you, but it is really unusual in Spain to be able to get a sponsorship for 8 consecutive years for any sort of research program. That is extremely unusual, and of course it doesn't speak about the quality of the products, but about the faith that the sponsor have and the problem that is still with us. You know, should the euro not be a problem, the report would have been stopped, discontinued many years ago. The fact that these people still sponsor it means that they still think there's a problem. So that's another important consideration. Okay, every problem has a solution. So let me put the ball on the table by quoting 3 individuals that I'm sure you all know. One is Larry Summers, and I do this on purpose. He, at Sintra last year, in August 2018, and this ECB's Jackson Hole comparison, which is taking place these days, I think. And last year he said, at least I read it on the Financial Times, saying, through history, we have seen countries without a central bank, but we have never before seen a central bank without a country. That, of course, is in the minds of everybody when they look at the euro. This is a central bank which has many special characteristics, but it is very unique, in which it doesn't have not a country, but even a group of countries that speak with the same voice on relevant issues. So that's one point. Second quote, Carmen Reinhardt, which probably most of you also know. She was the co-author of the famous book, what was it name? 500 years of financial folliness. This time is different. You know, this time is also different, I would say. So Carmen, on a publication on Foreign Affairs, also in December 2018, said, the first lesson of the financial crisis is how complacent policymakers had become. The second, that a system of fixed exchange rates can turn into an economic straitjacket. this also has some sounding ideas for what is going on in the euro. Maybe if we keep it as being a very special system of fixed exchange rates, then we do have a straitjacket and a recession in the making for good. So that's another point I want to make. The last quote comes from a European, for a change, from an Italian, in the honor of Gabriele, Romano Prodi, a well-known European politician and professor of economics. And he wrote in 2001, right at the beginning of the euro. I am convinced the euro will force us to introduce a new set of instruments for economic policy. It is politically impossible to propose them now, 2001, but someday there will be a crisis and new policy tools will be adopted. Well, the crisis was there. We've seen it, we suffered, we went through it in our different capacity. Some people here that had the responsibilities as central banks laugh because they know what I'm talking about. We did change significantly, dramatically. Anything, if you compare the European monetary union, the architecture, the institutional architecture of the euro area today to what it was in 2006, even to what it was originally in the treaty, it's a whole different world. However, my point is we still have a long way before we make it sustainable and stable. And that is what the euro is about, the euro report is about. The euro report is basically about making the euro better known and understood, and also confronting it with its weaknesses and necessary reforms. The book is a collective piece of work. What I've tried to do over the years, and again this year, is to combine people from different areas of expertise, from policymakers, regulators, practitioners, academics, even politicians and even lawyers, to give us their perspective on what they think has been happening during the year and what needs to happen that hasn't happened yet. And this year again, I think I have the luxury and the privilege to have been able to put together a group of individuals that is extremely good, remarkable for all sorts. Some of them are with me here. I will not mention them all because I will forget them. But I'm proud of them and I really thank them. I have not thanked them enough for being able to put together this book. Now, what I do in the paper is something a little unusual. No? They write their own chapter, and as they know, then I write my executive summary, which does two things. One, summarizes their main ideas, and two, confronts them or argues with them or even denies some of the things they say in their paper because I don't like them. So I try to convert their paper into my paper. And I do some sort of a policy paper, and this is what executive summary is about. After trying to be intellectually honest, summarizing the different views of different authors, then I give my own views. So if you read the report, you should look at the executive summary as my own exclusive responsibility. And in fact, sometimes what I do in purpose is bring out different points of view on that same issue, of the benefit to the reader, that can then look at the issues. And in this particular edition, there are a couple of issues where this is the case. One is Italy, and one is within it, actually, where we have different views on some issues. Some is with Santiago, on some other issues, on the issue on central bank digital currencies, and in some other instances. But I think this is probably better because one of the things we have to understand is this is an ongoing process, this is a work in progress, and there are different views. And we need to be able to confront them, expose them, confront them, and then come to a solution. So let me summarize very briefly the paper. I will not go into all the detail of the I was tempted to go article by article and saying their main idea, but then I decided it will be too long. I will try not to be very long so we can have a fruitful discussion. So let me say that there are three different parts of the book. The first one is what is called the existential debate about the euro, or what I call in much more colloquial terms, what does the eurozone or the euro want to be when it grows up? I mean, when we leave back the adolescence and we become mature enough institution, what do we want to be? So this is the old discussion about what is monetary policy, is fiscal policy, what is banking union, what is. Now in that part you will find a couple of articles that are, all of them are very good, but there are two articles that are very significant for what they say and for the authors. And one of them was is signed by the current governor of the Bank of Spain. He wrote it when he wasn't governor of the Bank of Spain, so he had a better let me say, he writes on his own capacity. Everybody here in the paper writes on his own individual capacity, does not commit the institution that they represent, which is very important so that they can speak more freely. And he makes a very interesting point, which I will go back to it, and it's about the needs, the quote-unquote failure of the Eurozone to resolve its basic problem, and that is to make the ECB a normal, regular central bank. What does it take to be a central bank like the Federal Reserve or like the Bank of England? The other paper by the former Minister of Economy in Spain. So, and I was hesitant to mention this because it looks like the paper is very institutional, and it is not. It is not. It does not represent the view of anyone in Spain except mine, and the authors in each particular article. And you will see points where they would disagree with it. And I will mention some of this. But the first part of the paper, I think it does, of the book, it does put on the table all the issues. So you will hear and you will be able to read comments on Eurobonds, on fiscal rules, on the regular treatment of sovereign debt, on how to proceed with banking mergers and acquisitions and creating European banks. So all these topics are addressed in different parts of the book. The second part is an analysis of two things: monetary policy in the Eurozone and the financial system, the banking system, to be precise. And you will see two articles that give a very quantitative description of not only the profitability, but also the liquidity, the capillarity, the solvency of the Spanish banking system in comparison to the European banking system. So we'll give you a very good image of what are we talking about. And this is an issue that this is a part of the paper that I also think is very interesting because it does defeat some of the conventional arguments. You know, let me mention just one data. There's plenty of data in the report that I will not use in this short presentation. But I'll give you one that I think is extraordinary because it came out in some of the conversations that I had before. And it's an idea of the extraordinary effort the Spanish banking system has done to restructure itself. The Spanish banking sector has spent both private and public money in the neighborhood of 300 billion. That is over 25% of GDP in restructuring the bank. Both public money with the in the agreement with the European Union, the famous agreement, but also private money, both in terms of additional capital increases by commercial banks and provisions, losses that were passed on to the shareholders. So I think it is fair to say this is a very large figure. It's not very different from the average cost of a banking crisis as large as the one we had in Spain in many other countries. But I think it's important to keep it in perspective, especially when we're asking now the banking system probably to pay an additional price. And I will go into this in a minute. And the third part of the report is completing the European Monetary Union. So there's chapters on the fiscal union, chapters of banking union, also very interesting chapters there. So as I said, I will restrain the temptation to go into every chapter. Let me go to the very final part of the paper, which are my 10 lessons of the year, what I call the 10 European lessons, in a very in a very rapid way. And every time I do this quickly, I will be much more how shall I say this? It comes out much more radical than what the actual thinking in the book is. Every time you try to summarize your main ideas, you go to the conclusions, you don't go over the reasoning, and therefore it sounds a little bit more radical. So my first conclusion is we have a political problem. The political problem is we still think that we can muddle through the crisis as if nothing had happened. We need a huge amount of political capital to use on completing the European Monetary Union, and the political capital is basically not there. Actually, there are some doubts on the will that the Europeans have to make the euro survive. And unfortunately, these doubts, these hesitations have re-emerged this year. I understand that the political landscape is very complicated, but I do also believe strongly, and I think most of the, if not all of the contributors to the report would agree with me, we also need very strong leadership for the new times. So I just hope that whatever outcome comes from the changing of the guard at the European institutions, that we do not commit the typical mistake of making sure that we appoint weak people from weak countries so that then we can use them as instruments for our national political benefit. So that's the first, my first lesson. The second is the ECB needs, and I will not, actually I will only talk about 5 lessons. The second is the ECB needs to normalize itself. The European Central Bank, as I said, needs to be a normal central bank. We have to solve what Mohamed El Arian calls the only game in town, no? Which in the case of the ECB is extraordinarily important. I'm very skeptical of this sort of beautiful adherence to how powerful, strong and lucky is Mr. Draghi, and how strong and powerful and competent and intelligent and smart and he is, and how lucky are that we have him. Remember, we used to say the same thing about Greenspan, and then we had a problem when he left. I mentioned this point because I think the ECB has to be less presidential. And second, it has to stop being the only game in town. We cannot count on the ECB taking the right decision at every time, because politicians, when they meet at the different summits, they don't do their job. You know, we're still talking about the same things we used to talk 10 years ago, and we just say, oh, well, forget it. We have whatever it takes. We have Mr. Whatever it takes to make sure that nothing will happen. Well, this game, you cannot play it endlessly. First of all, Mr. Whatever it takes is leaving. I may say fortunately, because not that I have anything against Mr. Draghi, we will miss Mr. Draghi, but I think we have to learn to have institutions beyond the mandate of the current person. You know, only institutions endure, and only the euro can only endure with a strong institution. So that's one thing. First, the ECB has to deal with the zero bound. And I'm very skeptical of some of the proposals, and in fact, the paper by Santiago on central bank digital currencies brings up some of these points. So that I'm very skeptical of these proposals that with some sort of digital gimmick, we can go beyond the zero bound. You know, we can use some sort of digital currencies to make sure that negative interest rates can be as negative as possible. And now I was surprised to see this paper by the ECB last week, where they come out saying because 5% of the deposits, because 5% of the deposits in the European banking system are subject to negative interest rates, corporate deposits, then negative interest rates can be as large as you want. Remember, we're talking about 5%. And the rest, 95% of the deposit base of the European banking system is not subject to negative interest rates. So there is a limit, unless we're saying that everybody will have their amount, their money, their holdings in the central bank in a digital currency. So anyway, you can read that discussion there, because I think this is the issue for the future. When Javier was saying, what am I thinking about? What I'm thinking about discussing the zero bound in some depth in the next edition. And then we have the contradiction between monetary and financial stability objectives for the central bank. You know, I know that the central bank is doing this extraordinary effort to tell the banks that negative interest rates are good for them. You know, they make them more profitable. They make them to give more loans and have less non-performing loans. Well, the fact of the matter is that every time there's a rumor in the market that the ECB will strengthen or continue with the negative interest rates, bank valuations fall dramatically, as we have seen and we will see for the current time. So maybe the market is not in the same vein as the central bank or as some of the academics. Just a point to keep in mind. Second point, risk reduction. Now, risk reduction strategy is necessary. It's important. We've done a lot, by the way, as you probably know, and it was in one of the papers coming from the Commission. That paper, we have reduced almost 50% the stock of non-performing loans in Europe since 2013, if I'm not mistaken. Now, risk reduction is necessary to make sure the banks are profitable, but cannot be and will not be a precondition for a sustainable monetary union. It cannot be, because monetary union is about risk sharing. It's about risk mutualization. It's about money flowing freely from places where there is excess savings to places where there is excess investment. If we stop that, if we insist on reducing the exposure of banks to risk or to sovereign risk, then we will have a problem. Second, There's a very interesting comment on 2 articles in the paper, one by Fernando Restoy, the chairman of the Financial Stability Institute, today. It was saying that sovereign risk has not been responsible for problems in the banks in most European banks in this crisis. So the loop between sovereign risk, excessive exposure, therefore creating a bank problem, is simply a false pretense. It's not only, I'm not saying this, it's him saying it. I fully agree with him. So, completing banking union, third point, is urgent. Now, what does completing banking union means? We all know what it means. We just don't do it. It is. We do need a European deposit insurance mechanism if we want, as I always say, if we want the euro to be the same asset, regardless of the strength of the sovereign where the bank is located, if we want to make sure that the euro deposit in a good Spanish or Italian bank, or which there are some, is an asset of the same quality, at least of the same quality, that the same euro deposit in a bad German or Finnish bank, of which there are some, we need a European deposit insurance mechanism. We can play around with financial gimmick as much as we want. We can do all sorts of beautiful exercises, but money will only move freely if we have a European deposit insurance system. More so, if we were to judge the success of banking union by its original goal, which is very simple, and the original goal we can summarize in a very simple two very simple goals. One, creating European banks. An integrated European banking system requires European banks. And 2, decoupling banking risk from the host country risk. If we were to judge the banking union for those 2 goals, we are very far from that. We are very far from that. So we need more mergers and acquisitions of banks. Now, it's interesting to see that this don't happen because, besides all the things that we know, because there are some regulatory obstacles, some regulatory impediments. Today, we still do not provide for risk geographical diversification between within the Eurozone as a risk mitigation factor in banks' risk assessment. There are also some structural issues that are interesting. Now, how are we going to have mergers and acquisitions if a significant part of the European banking system is not subject to competition? It's simply protected by the state. It is indirectly state-owned banks. And I'm not talking about Spain or Italy, by the way. I'm talking about other countries that everybody has in their mind. Where a very large part of the banking system is outside competition and therefore is not forced, is not subject to the discipline of the market. And therefore, why would you proceed to any merger and acquisition in that respect? And third, do we have excess capacity in the banking system in Europe? Now, we do have excess banking capacity, and we need more mergers and acquisition, not only to create European banks, but also to reduce the size of the European banking system. Then we will need a European insolvency procedure, a liquidation procedure, not only a European resolution system. Because we need to be able to liquidate banks with the same rules. We should not be able to use national rules to either avoid resolution or gain an competitive advantage. Last point, and I'm finished here. Strengthening the fiscal union. Just 3 very quick points, 3 very quick sentences, not even a point. We need simple, enforceable fiscal rules with well-known consequences. The trick is about being able to simplify the fiscal rule. We propose in the paper something similar to the expenditure rule that is used in the Spanish system, but this is just an example of something that can work. The important point here is, for the fiscal rules to work, we need any single European citizen to be able to understand the rule without a lot of smart economists explaining what an output lag is or potential GDP is and getting into heated discussions. And knowing in advance what the consequences are for not meeting the fiscal rule, not starting a long process of negotiation and what happens, what doesn't happen, etc. So single enforceable fiscal rules. We need a fiscal capacity at the Eurozone level, be it the budget or be it whatever. I have a very strong position against this fiscal capacity being at the ESM today for 2 reasons. One, because the ESM is not within the Euro legal framework. It is an international agreement. Therefore, it is like granting the fiscal capacity to the IMF, to the European international agreement. And second, more importantly, because it is a political decision. It cannot be a technical decision. And the ESM, and 3, it is a highly political decision the way it is conducted, because it still requires unanimity of the members before the money can be used. So I think that is a mistake. And then we will need a safe asset for the Eurozone. Now, once we have a safe asset for the Eurozone, and I know there are many proposals on the table, I think we have learned that financial creativity does not solve the problem. We need a Euro safe asset, and that is called a Eurobond, and you can call it whatever, but it will have to be a Eurobond for many reasons: to conduct monetary policy without fiscal debt, to operate normally in the central bank, but also to have capital markets union. Without a safe asset at the Eurozone, we will not have the depth and liquidity of the capital markets that we need for the euro to have this beautiful role of an international currency. So there is also a lot of time and attention dedicated to this issue of the safe asset. By the way, once we have Eurobonds, then we'll have to deal with the issue of what I call subnational credit events, call it sovereign debt restructuring mechanisms of the current national debt. We need, and the paper explicitly says that, some sort of Hamiltonian moment to compare with the US monetary union. But that can only happen once we have safe assets. Okay, so I stop here. Sorry for taking so much of your time, and I hope I've given you enough points to discuss in the agenda. Thank you.
I think that's indisputable that we have a lot of material to cover, following up from your quite comprehensive overview that to a large extent reflects what you can find in the Euro Yearbook. Okay, so now it's time to proceed with the discussion, and I'm very happy to have by my side Isabel Riaño, currently Deputy Director at the Cabinet of the Spanish Minister of Economy and Business. And on my left, I have Gabriele Giudici. Gabriele is the head of unit in DG ECFIN for the European Commission. As a moderator of a panel on EMU reforms, I am thrilled about the timing of it. As you all know, we just came out of a Eurogroup meeting last week. The next 2 days will be also decisive with the European Council and the EU Summit. I am sure that both of you have a lot to add on this. I will give you each 10 minutes also to comment on some of the points that you may wish to comment following Fernando. Gabriele, would you like to start?
Well, first of all, thank you very much for inviting me today to speak. As you say, it's a very interesting moment now. We are in the middle of important meetings, so it's good to go back to these issues with a longer-term perspective, which is in this what is put in this Yearbook, which is very rich. There are many good ideas, many interesting ideas, some controversial ones. So it's really good to look at these elements and try to put ourselves a bit in perspective. Now, that's also what we at the Commission have been doing the last period. I'm not sure you all have seen it. We, as a Commission, we have issued a communication just a week ago, which takes stock of the progress made over the last 4 years since the 5 Presidents report was released, and where in fact we try to assess what has happened, what is ongoing, and what still needs to be made. In fact, there's also a very nice speech which I would encourage you to read, which President Juncker has just delivered in Sintra, which is a very interesting one, and so it's also his own personal take on the last elements. And as he says, there are only 2 survivors of the events of 25 years ago. One is the euro, the other one is himself, and there's only one which will last forever, right? So it's interesting to look into that. So let me just try to catch some of the comments or the messages which come from this report, which Fernando just also mentioned, to just give a bit of a perspective. I mean, there is no time to go in detail of all these measures and all the elements, but just to give a little bit the sense. Now, as a disclaimer, I have to say that not only that I'm talking on my personal basis, but that I'm a very optimistic person in general. And so I tend always to see what can be done rather than what is not working. But of course, being optimistic on what can be done, it requires a realistic assessment of the situation and identifying where the problems are. Now, one very important element is political will. That's your very first point. Now, I have there a little bit of a perception that actually this political will is forming after a long time where in fact people were just looking elsewhere or looking very much inward in their own country. I think there are enough elements now which are convincing people that this time is over and we need to take care of ourselves. I think there are both external and internal reasons. On the global one, we have the tweets coming around, the decisions to, reverse a major agreement concerning Iran. We have Brexit pending, and then we have, populism internally, which is rising, but likely not as much as we, many feared. And the election results actually, I see them in a positive light, which gives us a signal, but also the opportunity to deal with that. So my sense is that perhaps we're at the beginning of a cycle where actually finally things will happen after many years where we've been calling for. Now, when is the push when does the push need to come? I was just discussing before, and I think it's a nice metaphor which I came up with, which is it's like when you're giving birth. You can't push too early. It's just painful and nothing happens. So we need to be ready for the moment, and I think we need to know where the moment arrives. We need to see that the belly is growing, and we actually need to make sure that the belly grows in the right, healthy way. And so I think that's where we are. I think, it really depends on expectations. People have been waiting perhaps for too much too soon. Last December was one moment. This June summit is another moment. I think the letter of Centeno to the President Centeno of the Euro Group to the leaders is pretty much telling that there's a lot still to be done, and then many things are to come back in December. So it's a question of expectations. And I think if one takes in a perspective where, in fact, it's just to go back to the discussion, to the speech of Juncker, I think it's very important. He's saying, when the crisis really unfolded, people could go back to something which was prepared long before, the Werner Plan, in order to create the euro. It was 20 years before it was already prepared. So it's a question of when is that moment. So let's see where it is. I personally see movements in the right direction rather than the wrong, although it's a bit of a zigzag in many cases. Now another point, and yesterday was we had this Brussels Economic Forum. We have the special session which is dedicated to Tommaso Padoa-Schioppa, and I very much like one sentence, which in fact I had the honor to hear directly with him in a closed meeting, which is you have to work. You have to have an active patience. So you have to be ready. You work until the moment arrives where people turn to you and say, what do we have to deal with this problem? And so I think that's where we need to place ourselves in this context. I think that's where we need to be. And I think if one puts yourself in this perspective, I would not call the last year as a lost year. I think there's been much more done than people realize. Of course, sometimes it doesn't deal with the big flashy things and items. Perhaps it's even less than that. But there's quite a lot of elements. I mean, besides the two areas which are under discussion now at the summit, which is DSM, treaty reform, and the BIC, which people have different views on what this is delivery compared to expectation, but it still reflects a lot of work which is done and which needed to be done. Now, not everything is closed yet. Although many points have been, there is an understanding, but I will not exclude that when there is a bigger deal at one point, some of the elements which were untouchable currently might be also looked at again with new eyes. Then I would say on the banking side, there has been quite a lot. The banking package is very, very important. The regulation on NPLs, the steps on risk reduction, MREL, all this I think is gone ahead. There is also one important process. I want to go back to this because I think it gives a good signal, but I'll come back to it later, which is the work on the banking union. So actually the EDIS, the European Deposit Insurance Scheme, which is the creation of this high-level working group, which in fact reported to the Eurogroup. In theory, it was supposed to be a confidential reporting, but it's I invite you to look at it because it's on the website of the president of the Eurogroup. It's quite interesting. But I think it gives an indication of how the discussions to go ahead in order to be successful. So I will go back to that. And then, another item which, President Juncker, in fact, launched both of these initiatives. One was the mentioning 2 years ago that, one of the elements for long term is the safe asset. And so we had, announced exploratory work, which is not public, but, we are, looking into these things. And then, of course, the international role of the euro. This initiative is a very important one. I think it marks a clear change, which actually has been backed by the report made by the ECB last week, which for the first time is a normative one. Let's say it's pretty much saying we need to do things, and they support the Commission, what it's doing, and so it's no longer benign neglect. So I think all these are novelties which go in the right direction. So if one wants to focus on what still remains to do, I think there is still quite a lot. I think one has to put yourself in the perspective, himself or herself in the perspective to 2025, which is still the one which put forward in our reflection paper, and in fact in the first President's report. And in that, there are a number of elements. Now, I think it's important to see also how much of these elements can be addressed in isolation, or in fact, how much of this can only be addressed properly once you look at the full picture. One recurrent discussion is about the simplification of fiscal rules, okay, or the implementation of fiscal rules, or the ineffectiveness of it. So all this, yeah, very well. We have announced that there is a review of this 2-pack and 6-pack, which will be working. There's the European Fiscal Board working on this. But the question is that even if you come ahead with some potential elements of reforms, would this be the right moment to enter negotiations on this once many other elements of the package are still unclear? So I put it as a question. I think it's still something to be addressed. First, let's do a review. We'll see what is really needs to be done. There are many ideas which go around. I think some of them also put forward by the Commission. But the question, I think, for me is important is really the approach. And as I said, I will come back to that in the context of the banking union. There are other elements that are important for the medium term, which we indicated, and on the institutional side, I think we need to do significant steps forward. That's what we're saying as Commission. One important element, which so far was not very successful, is the fact that the DSM should be brought under the EU legal framework. For us, was an important, urgent step to be taken during the crisis, but to be a condition that it should come back in the legal framework. We are struggling to reassert this principle, so we'll see whether eventually it will be mentioned explicitly in the treaty. So far, it's not the case. Then we made 2 other proposals, which I think are also important, and it's about the institutional setup, which is also seen in a longer term perspective, but probably might be relevant in the shorter one, which is the fact that the institution would be good to deal with the let's say the treaty assignment of competence, where in fact there is a national competence on the conduct of economic policies, but the European competence on the coordination and surveillance of economic policies. And this is now presented or resulting in a struggle. We had the case of the in the courts. There is now the Pringle case. We have on the SM also, which looks at that on the SM, which looks at these elements. So basically, there are one way which we suggest would be useful to address is by creating a position of a person who is able to represent both the Commission and the Member States and the Euro area internationally, in order to be the real engine of decisions which remain formally in the hands of the respective institutions, and where it's necessary in the member states, but I think there will be much more coherence internally, internationally. And this will go also along with the necessity to consider one further evolution, which is the idea of creating a treasury at European level, where in fact this could help in the financing in the market. On the international role of the euro, already mentioned that was a novelty, but we are doing work as concerns consultation with the markets. But there's one element which is also important and is really coming back as a feedback, is that you can favor the use of the euro in transactions, but in between operations you have to store it. You have to store your money somewhere, and you are not going to do transaction in euros if at the end you have to store the money in treasuries, right? So you need the assets in Europe which allow to do that, which brings to the question of whether you can create a safe asset. Now, this question, in fact, is seen as has been always been seen as a very long-term one, but I must say I'm a little bit heartened a little by the tone of the discussions, which is, and we can see with all the different, not red lines, but differentiation of positions into this work on the banking union, which I think is really a telling novelty. I think it's the first time in years that people have gone out from the short-term assessment of their own positions and how they can gain out of a negotiation with the member states, where it's basically a zero-sum negotiation, where what I gain you lose, and what you gain I lose. And that is inevitable when you just go in a very narrow set of discussions. And so what is for the first time taking place, and there are hints in the report of the high-level working group, is that there is for the first time a focus on the steady-state banking union. This is an interesting formulation, steady-state, because there is no specific horizon, but it's far enough for people to accept that the current position or the current position of others will no longer be there, because everything will be changing. You cannot foresee who will be in which position. And so this is helping to focus the minds on the fact that, a banking union, which is a proper one, has to be very different from the one we have now. If we want to compete globally, we must have banks which are a little bit larger than we have now, because if you compare to large U.S. banks, the top four U.S. banks and top 4 Euro area banks, the former ones are twice as large in terms of capital, and if you take the Chinese banks, they're actually 3 times larger than ours. So this has to change, and they have to create, operate in a pan-European banking system with pan-European banks themselves, and this requires really a totally different perspective. So what has been interesting there is that, in fact, the discussion has showed that in order to advance on something which is very concrete, which was the EDIS discussion, you need to look at the function of the banking union as a whole. And this has led to the identification of relevant issues for the discussion. Now, some things which you see as very far away, but in reality substantial for any movement on any of countries on different fronts. And so there are 4 pillars which have been highlighted for the moment as basis for further technical work, which has been what the mandate now of the Eurogroup for the next 6 months. And basically there is the EDIS and legacy issues for the banking system. Then there's a home host and questions. Then there's the implementation issues of supervision and resolution. And then there's a question of sovereign exposures, which actually like to discuss as mainly as functioning on the national bond markets or the bond markets in Europe, which some people see it as an approach to discuss regulatory treatment of bank exposure, but at the same time it also forces you to look at the question of whether the current national-based bond market is actually satisfactory for a European monetary union, where in fact we have demoted national bonds to because they no longer have a lender of last resort, and we have not created a European level. So the question there is, we finally have at the beginning of an approach where all these elements are starting to come on the table. I believe that the others which I just mentioned also will have to come back on the table. And only when all these things are recognized as relevant by everybody, and we've done enough technical work on each of them, then perhaps you can start to see the shape of the basis for a political discussion, which I think will take time. I don't think we're there, as I said. At least the next 6 months will be nice in this direction. Whether that will be sufficient, I don't know. But okay, I would say that is the only way you can go ahead. Otherwise, we'll just keep stuck in the past approach last year, where in fact the progress was difficult. I should stop here. Thanks.
Thank you so much, Gabriele. Isabel, I have no doubt that the last days have been busy for you. And I would like to hear your views in a context where more and more people are turning towards the Spanish perspective and what Spain has to say in the context of these discussions.
Well, thank you very much. And first of all, I would like to thank Kiko and Fernando for bringing me to this table, where I've been for some years at the Bruegel table, so it's very. I'm very happy to be back again. First, the disclaimer. This I need to do. I will be, of course, speaking on a personal capacity. These are very political issues and complicated. So whatever I say here are my views. I think, like other speakers, that this discussion is especially interesting at this moment, this week. We're having, on the one hand, the Eurogroup that took place last Thursday, Friday, deep into the night, as it was usual during the crisis and when difficult things were discussed. So that is, I guess, we could say it's a positive thing that ministers are discussing difficult things. We have the Euro Summit in 2 days. Of course, I think the Euro Summit is going to. There are other things in the European Council that will take the time of our leaders, but it's important that the Euro Summit also takes stock of what has been done at the Eurogroup level and give guidance and push things. We are at a moment where institutions are being renewed. We will have a new commission. We will have a new president of the. Everything is, as you say, in a state of waiting, but also in a state of let's initiate a new cycle and a new moment. And I think this is important too at this stage, because of the importance of political will. As I say, nothing will move unless this political will is on the table. And then we're having a lot of, I wouldn't say noise, but a lot of information coming from the Brussels Economic Forum, from Sintra. We're hearing tweets and retweets and comments about comments. And so this is bringing a lot of things on the table. And I think that this makes this presentation of this excellent book, and I'm very happy that in Spain we can have such a research every year. I think it's very important, as Spain is a very pro-European country, and we are always at the leading the European solutions. And I think this is an easy thing to say, but it is true, and I believe it is more so true now. So I think that brings also another dimension to what I'm saying. I think that what needs to be done is clear. We all know it. It's been there on the table for years. It's been written in the 5 Presidents' report. We're very happy that the Commission has launched this communication to remind us of all these elements that need to be completed to make sure that we reinforce. We talk about the EMU deepening. Like, again, well, this is all there, and it's moving, I know that Fernando is very provocative, and so when I was going through the book and through his executive summary, I said, oh, well, Fernando is really is not very positive. It's a disappointing and hazardous year. European excitement has vanished completely. These are quotes from the. But I wanted to bring them forward because it's as always, the glass is full or half empty. The European ideal is no longer attractive. These opposing visions of Europe, nationalism, old fractures resurfaced, weak European Commission. All this, of course, is taken out of context. So it's a bit of a provocation from my part. But this is true. But at the same time, it is true that one has to be optimistic, and that. Things are difficult. We have to negotiate with 19 countries within a complicated context. Slowly, it takes enormous amount of energy to move a little, but we move. So that's the important thing that we have to bring to take from what has happened last year and what has happened in the last Eurogroup. Integration has never been easy. And the more integrated you are, the more sovereignty you have to concede. So the harder it is, because it touches bone, as I say. When you're ready to touch bone, it becomes more difficult. And from an economic point of view, the 5 Presidents' report brings about what could be a perfect monetary union. But nothing is perfect in life. So we have to strive for the best and try to keep working towards whatever we can move forward. So I very much like this active patience concept. I had here, we have to be resilient, persistent, realistic. Nothing is ever perfect. Political processes are difficult. But at the same time, we have to cherish every step forward, and this is very, very important. Every step forward is a battle won, and what is important at this stage is that everything is on the table. I mean, nothing has been taken out of the table, and all the elements that you were talking about that we need to move forward, because of course that's how compromises are made, and that's how countries think that can see the whole picture, because if you see things in compartments, then it's even more difficult to advance. And I think this is important for this political will, and to avoid very sterile discussions like this risk reduction versus risk sharing. I think the concept is that we're all moving towards a better situation. Of course, we have to share. And I said this in a chat the other day, that sharing is very difficult, and that's what kids. When you go you bring your kids to school, the first thing you have to learn to share. It's very difficult, but it's for the better good. So this is important, and I think that one important thing in moving forward, and I'm being a bit, more political than economic. The economics of things are clear, is that we need to build trust. And when there is trust, red lines can move. And of course, we're coming from a very difficult period of a crisis where there's been a destroyed capital of trust that needs to be rebuilt. And this is very important. So it is important to keep things on the table. As you were saying, for instance, Eddie's. Again, the political roadmap for the political roadmap for the roadmap of the political roadmap. Sure, but we have the elements of what could be the steady state of it. So there's something that we can look forward to, and those elements are on the table, so we can talk about them. So that's very important. Some elements, I think, also on the political front that are important in this. At this moment. First of all is that, as José Carlos was saying in his presentation, the expected rise in populism within the European Parliament has not materialized as the omens were telling us. Of course, there is populism, but the four, I'm taking in the Greens, of course, groups can agree on moving forward in this integration, and this is very important. Then Brexit. Yes, Brexit is a disaster, basically for the British. That's and then if we want to take something positive away from this Brexit, is that it has united European countries. The member states have been united in dealing with Brexit, and when people see what the disastrous consequences that getting out of the Union can bring, maybe they will be more willing to move forward. So that's an important thing. Of course, we have these geopolitical trade wars, China, the US. So those are elements that should bring us, again, closer together. Because, it would be, I don't think any country believes that alone in this world they will go anywhere. So I think it's important that this idea is reinforced. And then there's this political moment. In your executive summary, Fernando, you're saying that the Franco-German powerhouse is faltering somehow. It's true, and it's this Franco-German, how would you say, pair is important to move forward, but it's not sufficient. And what is clear now is that it is not sufficient. And I think that they both know that it is not sufficient. And this is very important for a country like Spain, because we're going to have to act more collectively in terms of moving the agenda forward. So far, I mean, Commission has been putting proposals on the table on the European Monetary Fund, on a lot of things that, with no response from member states. Member states have responded when Germany and France have met and made declarations. Well, that's great. We are very happy that Germany and France put forward, move things forward. But I think that now it's very important that they bring along other countries. And I think Spain really, and I'm saying it because I believe it. I mean, we've been absent from the institutions for a while. We've gone through a very difficult moment. I mean, it's not because we don't have a will to contribute to the agenda, but because we were going through a very difficult situation, and our political capital was a bit more complicated. But now I think that we're back, and that both Germany, France, and others, this driving seat has to be more comprehensive in terms of dealing with different sensitivities, and certainly we are, I think, playing this part already, at least at the Eurogroup. Now, if you all sure want to reveal very big secrets of what happened during the Eurogroup. I think the result is there. It's on the term sheets of this budgetary instrument. It's on the ESM treaty changes and the precautionary instruments that have been reinforced. I'm not going to go through what is on the table. It's there for everybody. What I can say is that, of course, it is difficult to agree. It takes a lot of energy, a lot of meetings, a lot of Eurogroup dinners, a lot of Euro working group meetings. But we have, finally, and it might be not very much, but we have the reform of the treaty with the backstop. We have the precautionary instruments. We have these steady state EDs to look forward to. So those are very important, I think, advances. Little by little, as I was saying, battles are won. And we are talking about a budgetary instrument. What I would highlight from that discussion is that we're talking about a Euro budget. This was anathema years ago. So this is on the table. What is on the table we might like more or less. Some of us might think that is certainly not what we were thinking about. Some others say, well, this is a concession so that we can have something that is called budgetary instrument on the table. But it's there. And this is very positive. In this discussion, Spain has been very pushy, very ambitious, because we truly believe we need this stabilization capacity. This is something that for other countries is more difficult to swallow or to accept, or they don't believe this is an important feature. So it's always, very complicated to combine something that looks like a budget. So now we have at least an instrument. We have an instrument that is based on investments, reforms too, but I would like to underline the investment part, because investment can be a big stabilizer when there is a crisis. There's talk about no conditionality more than the one that is attached to the structural funds, and we have elements that can modulate some sort of stabilization, co-financing rates. We have contribution keys. I mean, still a lot of work is needed, but there is something. To my mind, I think it's a bit disappointing. We would have liked something more important, something more with the word stabilization, something where. But we're getting there, and we're getting somewhere at least, and everything is open. I'd like to remind that the Commission also has a proposal on the table that has been quietly forgotten, which is the European Investment Stabilization Function. Well, maybe that's something that we can bring back to the table and to complement this instrument. I don't want to take much more. I don't know how long I have been speaking, but I mean, I want to bring this positive vibe to the table, in the knowing, of course, that everything is difficult and that sometimes it is frustrating. But we need not be swallowed by this frustration and keep moving. And just to finish, let's look back 10 years. Where were we 10 years, and what has been built in 10 years? And in terms of historic perspective, 10 years is nothing. So let's take this as an optimistic view of what is going to come. Thank you.
Thank you, Isabel. I think this is a wonderful tone to end up our first round of presentations. We have 15 minutes ahead of us, and as always in every Bruegel event, we are keen to hear from the audience. But before I will give you the time to express your, of course, interesting questions, I would like to give the panelists an opportunity to respond to some points that may have been raised. I will be very strict with time, so be short, be concise, ideally 2 minutes each. Ideally, let's try. So who would like to go first? Maybe Fernando.
Yeah, can I? I'll try to be quick. We've seen a perfect example of the bottle half empty, half full. So that stays there on everybody. And of course, I think the position has, or the different perspective has a lot to do with the institutional responsibility that one has. You know, being in the academia gives you the luxury of just seeing the bottle half empty, and that is totally cool. But let me remind you. When you mentioned this idea of the budget idea as an anathema, a thought came to my mind. It was 2011 when I was discussing these issues in Berlin at the Minister of Finance, and everything went beautiful talking about the euro until I decided to mention the word banking union. And at that time, a very prominent member of the German banking establishment raised, a very, very big man, quite small, raised and said, I will dedicate the rest of my life to make sure the banking union does not happen. Well, so yes, it did happen, but in the middle, a tremendous amount of suffering and loss took place. So my concern is, yes, I know there's some movement. We now are very proud because the budget idea is not anathema. We can discuss it. My problem is that 2 years ago, in the report 2 years ago, I already said the Commission has mentioned this idea of a European budget. Good. So now it's come from the beautiful world of academics to the world of real life, to political decision makers. 2 years later, I still have to say the same. It's there somehow, fine, but nothing has happened. And I'm afraid nothing will happen. So let me just skip to my last comment, because it links to something that you both have said. This idea of building trust, and I fully agree. And it has to do with your idea of how do we get a grand bargaining solution. And I fully agree with this. I mean, this piecemeal approach to complete the European monetary, banking, economic, fiscal union will not work, and I think that's something we have learned. It's taken a painfully long process to learn this, and I'm very happy that you mentioned this idea of the steady state of banking union, because I opened my report for the last 5 years saying what a normal banking union looks like. So let's see what we want to build. How this thing, how this wild animal that we are creating has to look like to be able to be sustainable. So let's have a clear image of the end game. And once we have the end game, then it will be much easier to get there. So yes, I'm very happy that it's taken only 10 years to decide that we need an end game picture. So fine. Problem is, we are still very long from agreeing to this end game. And that's what I have. And so let me, and I finish here, I have many other points, but just let me finish with something that is in this report. And as I mentioned, I'm very happy that is mentioned here. And this idea of the grand bargaining. We do propose, and we've consistently proposed this from at least the last 4 reports that I remember, a way to build this grand bargaining. And this is making risk reduction and risk sharing compatible by advancing forward in parallel banking union, that's EDIS, and risk reduction, that is some restriction, with fiscal union. Because we cannot have this idea of the fiscal union being sort of an obligation of somebody to pay for the others. It also has to be an obligation to respect the rules that we have given ourselves. So if we're able to put together at the same time, moving forward in risk sharing with fiscal union and moving forward in this grand bargaining in meeting the budgets and meeting the rules, maybe this grand bargaining idea can work with one caveat that I think is important. We have to forget about the legacy cost. The legacy cost is another issue. We have to agree on what we want to build, and then we will discuss how we pay for it. That's why I talk about the Hamiltonian moment. We'll decide what we will do with the liabilities already existing. But let's talk about what will happen for the future. And once we have the future agreed with this combination, then it will be a lot easier to decide how do we pay for the past. How will we structure the legacy? That's sort of the idea of the grand bargaining that we propose in the report.
Okay, thank you, Fernando. So, in short, the piecemeal approach of reforms will not work. Steady state is good, but it took a while to get here. Eyes on the future. Let's not forget the fiscal union. Gabriele, do you want to?
Yeah, I want to come back to the point which Isabel has made, which is, I think, perhaps where we need to look at it again, which is where you said we all know what to do. I actually think that the source of the problems we're having, trying to identify what is the need, what is needed for the grand bargaining, is exactly that we think that we know what to do, but in reality we don't. And my perception is that there are many people, I'm looking at it, I think I have one view, and when I look at all the other, I have the feeling that, everybody's looking from really his own or her own angle, and the big picture is missing. Now, so it's, in fact, I had actually the feeling there are symptoms in many areas of underlying the dynamics which are not captured yet, and we are trying to fix the symptoms, not the problem. And everybody's coming with the medicine to fix the symptom, and of course the other one is not taking or is taking, and then is feeling worse, and then is accusing for the wrong medicine, or is not taking the medicine and is accused of not being taking the medicine despite all the good recommendations which have been given from one side to the other. So I think that's a general. Now, why is it a problem? I think, first of all, we're mixing different concepts. I personally not agree with the fact that you can move on a banking union only with the fiscal union. This is mixing two issues, which is different from risk sharing. Just fiscal union is something different. To me, it means agreeing on a budget and spending it, and you decide together how you do it. Whether it's for risk sharing, for national policies, this is the fiscal union the way I see it. I don't think they need to go together. You might want to bring them together, but the necessity of linking the two, I think it's just complicating the discussion rather than simplifying. The other point is about, it was Jean Pisani-Ferrius when I made this nice paper talking about, is it a distribution or cognitive problem behind the lack of progress on the reforms? I think it's seriously a cognitive issue. And in fact, I think it's because we are not understanding what is functioning. As I said, I had the perception many of the things are symptoms we're looking, and the symptoms are of an illness which is underlying the function of the EMU, which is relying on the function of the financial union, which relies on the function of the banking union, and which relies at the core of the financial system on national bond markets. The fact we have asymmetric bond structure, which is scarce, increasingly scarce, is amplifying any shock. I was just going back through all the shocks we lived in the last 25 years. It's all coming from outside. The 95 crisis was Mexico. Then we had, the bubble, the dot-com. Now we had everything. All shocks, and then they amplify through the spreads which we have in Europe. In 95, there was also the exchange rates in between the bond, the Italian BTPs, the Italian lira, the German mark, the German Bund. We took out exchange rates in the middle. The rest is still there. So as long as we don't recognize that there is an issue which is having an effect on the content of monetary policy, which is having an effect on the outcomes of fiscal policies, which is having an effect on global demand for the euro and exchange rate and external imbalance, it's having an effect on internal imbalance. All this, if we don't want to enter in this discussion, I think we are not going to. So I'm happy that finally something which has always been put in the very long term is starting to be considered as possible item for discussion for potentially addressing the state banking union. It's a very fair, but I tell you, 3 months ago, in January, when I was the first time in that I was asking, look, do you think we can bring the safe asset question and bond market question in the table of dialogue working group? People started laughing. Okay, so in 6 months, it's an immense success, and everybody's talking about it. You know, Juncker just talked, the ECB came out saying that it's important because it's distorting the functioning of the bond markets, the lack of it. You know, we have the international role of the euro, we have many elements. So all this needs to be brought in a picture. I think unless we start having a proper discussion what really functions, I'm not saying that I have the answer, but there's been topics which have been taboos. And I think unless we bring all of them, then we don't fix it. And I think that's starting. Then I think there we will find a solution, but let's try to avoid putting things which are not strictly necessary. Thanks.
Isabelle.
Yes, I wanted to comment. I mean, on something related to trust, because I think from the political point of view, it's very important. Is about economic surveillance, and it's about the rules. It has been mentioned. The Commission is going to look into this. That the current rules are very complicated. Nobody understands them. They're based on indicators that are contested by countries, including my own. So the whole exercise, at the end of the day, is perceived by some countries as political meddling. And that is very important that it's not so. To make sure that this part, I mean, I trust because you're doing what you need to do, and then I can move on other things. So I think this part, the part of reviewing how the 6-pack and the 2-pack and the rules have been working is extremely important, and make them transparent and understandable. So that there are no questions in an ECOFIN or in an Eurogroup on, is the Commission really doing his work, or is just being political? So that's an important thing. And at the same time, I also believe that there's this underlying concept of virtuosity and non-virtuous countries. I mean, when in a monetary union, there are spillover effects on both sides. And that's why the macroeconomic imbalances procedures exist. Has it been used? No. Maybe it should. I just leave it there.
Thank you so much for all of your contributions. I mean, I think it's clear from our panel that we could keep on doing this for a long time, but we will not. I would like now to turn to our audience. So please come forward if you have any questions. Make sure your question ends with a question mark, and please be kind to identify yourself, your name, and your institutional affiliation. I see a question over there.
Thank you for the presentation. All of them were very interesting. My name is Pavlin Rusanov. I work for the European Parliament. I have a question primarily to Mr. Fernandez. Talking about the Eurozone and Maastricht criteria. Let's take one of these Maastricht criteria, public debt as a percentage of GDP. It should not increase more than 60%. No country from the Eurozone should not have more than 60% public debt of GDP. For more than a decade, the vast majority of the countries violate this criteria. And my questions are I have two questions, very simple. One of them, is this criteria relevant anymore? And if not, should we increase it officially to 80, 90, 100, 120% or something like that? Thank you.
Any other questions? If so, we take them in a bundle. Yes, here in front, please.
Thank you. Well, I have a question for the panel, and my question is on the.
Please, name and institution.
My name is Javier Arias, is representing BBVA, but I'm speaking on my own behalf, not to. So I had some time ago the privilege to be in a meeting, and they were one of the number 2 of the Minister of Finance of Germany. and he was saying that I don't want to. Well, so everyone knows his name, so I don't want to quote it. But what he said that you were talking on Isabel, you were talking on trust, and he said he was talking on paranoias, and what he said that there were too many paranoias in Europe. And he was blaming himself, saying that the Germans, they had the paranoia with the eddies, the Italians, they had the paranoia with the risk reduction, and so on and so forth. So the thing is, and he said, well, we have to find out a solution, and we have to probably to have a meeting at closed doors and trying to find out what sort of paranoia we have, any one of us, and trying to fix it and trying to understand why, and set a sort of roadmap or a sort of solution which could be feasible, meaningful, and achievable. So I think that this is more a sort of, well, although this is it's a complex issue because that deserves a huge political investment in accomplishing this task. But at the end of the day, there is some time bought by the ECB doing what they are doing already, but time is not, something which will last forever. So, and one of the intrinsic, in my view, weaknesses of the euro is that we don't have a European treasury. So we have we try to solve that with different institutional architecture, but that is a reality. So and I think the markets they're always going to the weakest part of the of the markets, and this is one of that. So my question is a lack of time, or time is running out, and everyone knows what is the issue, what is the problem. So please do it.
There's a third question in the back, and are there any other questions? Well, we'll see after.
Oliver Pitzek from the European Trade Union Institute. I have a question regarding disconnecting the banking union, progress in the banking union from the fiscal union. Now, I don't really understand the argument, because if you're saying, okay, we will not have a fiscal union, which is likely looking like that, right? But we will advance with the banking union, and we don't want to have Italian banks, say, holding more than 25% of their assets of their government bond assets as Italian ones. Then don't you aggravate the problem, right? Because the German banks may not want to hold more Italian government bond assets, and now you force the Italian ones to hold less. And exactly this amplifying mechanism that you talked about before, that we always see in the crisis, that is actually at the core of the problem of the Eurozone, because every country that still has their own currency does not have this capital flight that we have in the Euro area for countries under pressure, right? So isn't that a problem? And shouldn't we rather not have a banking union than if we don't get the fiscal union, right?
Thank you for your questions. I think 3 is a lucky number, given that we're 3 panelists in the table and 1 moderator. So let's maybe start with the last question, if that's okay with you, disconnecting the banking union and fiscal union.
Yeah, I didn't say that we should go for regulatory treaty and sovereign exposures. I said we need to deal with the question of sovereign exposures and the function in the market. How you solve it, I think I've not given the prescription which you are putting in my mouth. I haven't. It doesn't mean that you cannot consider it as part of a broader discussion. As I say, if you would have banks naturally shifting towards the European safe assets, there are no significant holdings into the bank's balance sheets, and therefore how you charge the capital in this respect, I think, becomes less relevant. Now, the implicit thing is that if you buy a European safe asset, and this one is being used to refinance the funding of part of the national debt, which is what you put as a treasury task, in a way you're de facto creating demand for the debt of every member state. So anybody in Germany who's buying the European asset is buying 17% of Italian debt as well, and so on and so forth. So it's a forced coordination of on the other side. Even if you don't like the other, you are buying some of it because it is being created in such a way that is safe enough and the asset reference for the banking system of Europe. So I think that's the way. Then the other question about fiscal union in general. I mean, the fact is that we are designing everything, which at the end means that all the sharing is actually done by the private sector. So aid is in itself, it's a private sector concept, right? It's paid by contributions of the banks. Having a pan-European bank which has operates across borders as a diversified private sector part of the balance sheet, and then if on top of it has mainly a safe asset at the European level, it's fully diversified. So, for this you don't need any fiscal union for doing that. But you created the asset, and this overcomes the current link between fiscal policies and the banking and banks and everything. So I think that's the focus where I think it's a priority. As I said, it doesn't exclude that you might decide to do more European bonds like EIB to do a project bond. I think there's nothing against it. But these will be a few more billions, not an asset for financial markets. So these two things are separate, and one might come on top of the other perhaps later. I think it's easier to do that way rather than starting the other way around.
Maastricht criteria or that, but
no,
we're
because
running
I think,
over time officially.
but it's important. It's an important point of disagreement that they should be the table. Now, I fully agree with what Gabriela was saying in the first part of it, that we would not worry about the sovereign exposure of banks if we have a euro safe asset. But that's important to understand the logic of it. So we are attacking the symptom, not the illness. So fine. But we also have to consider that we will not have banks mergers and acquisitions unless banks can manage liquidity Europe-wide. And we won't have that until we have a European asset. So all these things are related. Now, what I don't agree is that when we look at the steady state of a banking union, I do not know of any existing surviving banking union that does not have a fiscal union in the following sense. I'm not saying we need to have the same taxes everywhere, but we need to have some fiscal capacity. That's typical of fiscal union. Second, we need to have the ability to bring taxpayers' money to deal with banking issues, because I think we live under the illusion in the Bank Resolution and Restructuring Directive that there will be no taxpayers' money for the banking sector. That is just a myth. I mean, hopefully not, but if and when we have another systemic banking crisis, there will be taxpayers' money. Let us not kid ourselves. And for that, we also need a fiscal union. And we need a fiscal union for the central bank to be able to have a monetary policy that is conducive in response to the fiscal policy. So we need, Gabriel, a fiscal stance for the Eurozone. And to do that, we need to have a fiscal stance for the Eurozone. We will not do that through the fiscal rules. The fiscal rules are to avoid the externality that the free rider problem imposes on the other members of the Union. Period. That's the only reason why we need a fiscal rule. The fiscal union is about something much more important. That is to be able to have a process by which the European Union, the members, agree to a fiscal stance for the Eurozone. And that we need for the ECB to be. That's why I think we do need a fiscal union.
Can I just ask a clarification? Because I don't know if our investment stabilization function would be adopted. Mm-hmm. Would you call this a fiscal union or just a stabilization capacity?
It is
because that's I think what you are asking for is a stabilization capacity. I think we pollute the concept by saying because fiscal union can mean to others many more things, and it's anathema for them. So
was exactly the same discussion we had on banking union. It was anathema because it meant the German taxpayers' money was going to be used to rescue Spanish banks. And that's exactly what happens in any existing steady-state monetary union in the world. There is no monetary union in the world where money from taxpayers in a certain region is not used to pay, let me use deliberately provocatively this example, in Germany to pay for Spanish banks. That is the way it happens. I don't want to use any other country in anybody's mind. That is exactly how it works all over the world. So we look at the steady state of the banking union, it means a fiscal union. Because this is a quasi-fiscal item.
But this is to be paid eventually also by the private sector.
It will never happen. I mean, we can dream of the private sector paying for this. But it has never happened in history, and it will never happen in history.
You are also one of those who classify the ESM as a fiscal transfer then?
Well, it is a fiscal transfer.
It is? Okay, fine.
This and other themes in upcoming Bruegel events. No, thank you so much.
Can we address this issue?
One
debt?
minute.
No, just 1 minute. Because there's a specific question.
Yes, absolutely.
I have no interest in dealing with it. First, the Maastricht criteria are or were the conditions for members to join the European Monetary Union. This doesn't mean that they have to meet them once they are in the Monetary Union. One point of clarification. Second, the Stability and Growth Pact has a debt rule that has, and which supersedes this idea of limiting the debt. And this fiscal rule is more dynamic, as you know, or most people in the room know. Depending on your position, then you're asked to reduce at a certain speed the amount, the debt to GDP ratio, okay? Now that has not always been met. In fact, it hasn't been met. That's why, again, and talking about the fiscal, that's why I propose, and there is a very simple expenditure rule which will be adjusted on the amount of the debt to GDP ratio. And that's how it theoretically works in Spain, the expenditure rule that was adapted in the stability law. So there's a way to deal with this. I personally do not think it would be a good idea to say now we will put the threshold 100% of GDP, because then we will get into this heated discussion in the academia and in the policy world. How large can a debt to GDP ratio be being sustainable? And that depends on so many circumstances. One of them is trust, by the way, which we shouldn't get into it. At least I don't think we should get into it. So yes, we need a simple fiscal rule that is conducive to reduce the level of debt. Period.
Good. I think this brings our event to a close. Thank you so much for coming, and also for the ones on the live stream, thank you for watching us. I hope to see you very soon. Please help me in thanking our panelists for an amazing discussion, and have a wonderful rest of the day.